Hi, I'm Michelle Coleman and I'm the Director of W Financial. We're a mortgage broker company that specialises in investors. We look at unlocking equity, restructuring your finance and also access you better terms so you understand what your property strategy is, because it's not always about the rate, it's about a lot of other things. We look at understanding how your finance works and how to maximise your capacity so you can buy more properties safely. We also have direct access to 5 wholesale lines of funding. So we go through different lenders as well as our own branding as well, which helps you, the client. To give you a little bit of background of myself, I have a property portfolio over $3 million. We started out with 2 properties and we built it up to 12 properties in a space of 2.5 years. As a mortgage broker, I've settled over $500 million worth of loans and I've pretty much seen every scenario: renovation, subdivision, development, commercial, and even those things outside the box. My 1 month highest settlement was $19 million, which most brokers don't settle that in a year. I've been an Ask the Expert for Your Investment Property Magazine and they've actually been featured on the cover. I've been an award-winning broker with MPA, which is Mortgage Professionals Australia, and also an elite performer with all my aggregators. So today we're looking at property finance to help with your subdivision project. There's actually 3 stages that you need to look at, which we'll go through today. Stage 1 is the actual purchase of the original site. Stage 2 is processing the subdivision with your bank, and Stage 3 is what to do with your new equity. So Stage 1 of your subdivision project is to purchase the original site. When we look at this for you, we look at just a standard purchase strategy. So we look at your overall long-term strategy, what your goals, your needs, and what your current position is. We then try to get the highest loan-to-value ratio, or LVR, for you based on your position and also your risk profile. We do this so you can reduce what you need to put into the property purchase, so reduce your contribution, as well as at the end it will reduce your return on your capital ratio. It also allows, when you go to release the equity later on, that you can actually release more funds for you to use for other purposes. So when we do your lender selection with all our clients, we actually look at a whole range of things. So we look at what loan-to-value ratio that you want to look at, so what deposit you want to put in or what deposit you need to get out with a refinance. We also look if you're buying in a trust or not in a trust. Different lenders will lend to different types of trusts. We also look at your serviceability, what you can afford to borrow, what order of lenders we should go with based on your long-term strategy. But we also look at your overall rate and the fees. So we look at the percentage rate, the application fees, ongoing fees, solicitor fees, and mortgage insurance. There's a big difference in not just going for the rate, because sometimes the fees can outweigh that. So we look at the whole package when you're looking at your new purchase. So Stage 2, when you're processing your subdivision with your lender, involves a couple of steps. You'll actually work really closely with your solicitor or conveyancer with this stage of the process. So what actually happens, once your plan of subdivision has been certified by council, you need to get your lender's consent to actually separate the titles and have 2 new titles. Your solicitor or your conveyancer will actually help arrange this mortgage consent and actually lodge it with the titles office and then help you through the process to actually get the 2 separate titles issued. What the lender will do once they get your application to consent, they'll review the documents, including the plan of subdivision, different planning, make sure that the property is actually going to be worth more or the same than what it currently is, to make sure that their loan is secured safely for them. So they actually do a new valuation on the front house or the side house, depending on your project, and also the new block of land. Once they're happy with that, they will then actually have the mortgage over both titles. So they won't actually release one, they'll actually take your loan over both titles. So you actually have to work with your lender to get the consent for then the council to issue your approval. So Stage 3, which is the exciting part. What do you want to do with your new equity? There's a couple of options you can do here depending on what your goals are and what you'd like to do. So you can actually sell the rear block and then obviously retain the profit for something else. You can actually get a new loan for the land only, and you can either top up with your existing lender or you can look at refinancing one or both with a new lending depending on the situation. The reason why you'd go maybe with another lender could be difference of valuations, your circumstances have changed, or just there might be a better product out for you at the time. The other thing you can look at with your equity is doing the construction on the rear block. So you can look at getting your plans and permits, get a contract, and we can actually use the equity in the land to then build the new property without any deposit, and you probably might get some money back depending on the valuations. What's really important with all the three options when you're looking at getting your equity out is the partial discharge process. What this is dealing with your bank to access that equity, depending if you sell, stay with them, or you're going to another lender. you need to actually complete the form, which is called a discharge form, and you're actually completing a partial discharge because you will be most likely leaving the original security with the first lender. So what you need to do is instruct the new lender to do a new valuation on the security that is remaining with the bank. This ensures that they have the current value, and when they actually release the title and release the loan and you create your new loan and get the equity out, that they'll actually reduce the original loan to the original loan to value ratio that you approved at against the new value. So what this means is that you're sucking all your equity out at the most capacity. So what we can do, just to explain how this actually works, I can show you a real life example, and we'll actually do one of these reports for you, both with an upfront guide as an example of what some of the projects that Chris can do, but then we'll do a bit more specific for when you do actually find your own project. I'll give you some examples now. So here is an example of how the numbers would work, and we actually give you this report when you're working with us based on, we can give you a general example as well as when you get more specific when you find a property. So this example is based on a 95% LVR, and then you just go through and we can work out the numbers. So you look at your purchase price, which in this case is $235,000. We've allowed subdivision costs of $15,000. I've also included the home study fee if you're a member, which is $4,995. We've given the land stamp duty, the mortgage registration fee and the land transfer fee and solicitor costs. These are all your purchase costs when actually purchasing a property. I've also included the bank's mortgage insurance, and this is based on 2.43 of the loan amount, which is what the average mortgage insurance cost will be. So then it gives you a total cost to actually do a project. In this case, it's $270,845.40. So when you're getting a loan, the loan will be 95% plus the mortgage insurance. This is not the case with all lenders and not in all situations, but there is a couple of lenders that we can do that will add the mortgage insurance. So what this means is that for a project like this, you only need roughly $42,000. What will then happen is when you go to the next stage and you actually separate the titles, the front value for this example we've put at $215,000 and the new block will be $95,000. This actually means that you've made a profit of $39,000 odd dollars, which when you calculate that with what you've actually put in and all the costs, it actually gets you a profit ratio of 14%. But the real important figure here is the return on your capital investment. So you've actually put $42,000 in, but you're going to get $39,000 out, which gives you a 93% profit ratio. Then down below, we actually work with your cash flow, which is based on the repayments on the loan, which includes the mortgage insurance. We've then just allowed rental at $200 per week, which actually means you will actually have a surplus cash flow per month of $133. So once this is actually settled, this property will actually be putting money into your pocket, both cash flow and equity. The next step is the really important step, which is actually when you're getting the equity out. Then you have, when you look at those two figures that you have for your total valuation amount, the total valuation would be $310. You have your original loan reduced down from originally $228,674 down to $204,250, and this is really important, as I explained in doing the partial discharge form, to make sure your lender reduces your original loan down by the original approved value ratio to the new valuation amount. This means that your the remaining security will be still at 95%. When you get equity out or your refinance or top up, most banks will only go to 90%. So the second loan, if you got the equity out, would be at 90% of the value of the block. This loan is $85,500. So when you add those two together, take away the current debt that you have, this means you'll actually release $61,000. So now comes the time where you have to get your finance application ready and get your market ready so you can jump on some of these opportunities. So what you need to do is understand a couple of things. One is your finance clause. A finance clause is actually there to help you, protect you if you can't get finance for whatever reason. There is a timeline for this, so we have to make sure we get the application lodged, go through the lender's questions, get the valuation done, and get everything formally approved within that time frame. So it's really important that you understand what that date is and really act quickly to getting your documents as requested. Also be aware of your settlement date. So you need to know that you're not going away, not changing jobs, all those kind of things that's really important to making sure your property settles on time. The other really important thing is getting your supporting documents ready. Follow the checklist that we give you and make sure you sort of go through, make sure you have everything there at once and send through. We don't want things that aren't correct, outdated, can't read them. Making sure it's all clear and legible and exactly what we've asked for. Be prepared where possible to get a pre-approval in place. A pre-approval actually means that the lender has already assessed you, and then all they have to do is assess the property when you actually select the property and purchase. This cuts the processing time down considerably and removes a lot of stress for you, your agent, us, solicitors, everyone involved in the transaction. Another important thing is to understand your numbers and be comfortable with them. The mindset around investing is really important when you're going through the finance application. We can be comfortable with your numbers. We go through what you can borrow, make sure you've got buffers, but you need to also be comfortable with it and be comfortable with debt. This can actually make a massive difference to the whole finance application process. Last but not least is always ask questions. What's really good is to email through a whole heap of questions and we can address that, and then we can make a time to go through it one by one and make sure you're comfortable and understand the whole process and what's required. This makes a big difference for the whole application as well. So we're now at the end of our finance presentation. I hope you've got some information, but if you've got any questions, please contact our team. We've got Casey, Peter, Jade and myself there to help you to get your finance ready, answer any questions and get the ball rolling so you can get this subdivision project underway for you. Thanks.